Okay, so basically, I get a question very frequently on mail, on DMs, in Telegram. Um, Pretty much, I see it all over. Is which time frame is the best time frame to trade? And the truth of the matter is, there is no best time frame to trade because every trader is different. Every trader's expectations are different. So one might be a scalper, one might be a swing trader, and one might be a position trader or a day trader. Okay, now in terms of which time frame would be the best time frame, well, obviously, for entering a trade, you're going to want to use a low time frame. But without knowing what is happening on a higher time frame, it is very unlikely that a trade will go your intended direction for any amount of time. Okay, so what I mean by that is if you are in the hope that you've taken a trade on a 15-minute chart and now you are hoping it's going to swing your direction that you have bought, for example, the chances of that actually transpiring are very low because you haven't done the work on the higher time frame. So how can you say without gambling that the 15-minute chart that you've entered on without knowing what is happening on any other time frame is correct? Because you could be seeing a buying opportunity, but the order flow on a higher time frame is a bearish order flow. Okay, so you need to know the higher time frame, and this goes down even to a scalper. It doesn't mean that because you're scalping to catch 10, 20, 30 pips a day, it does not mean that you shouldn't know the higher time frames. Okay, so the higher time frames tell us where price is going to and where its objectives are. Once it reaches its objectives, then price is likely to reject that zone and not go any higher or go any lower. Okay, so someone actually asked me, well, what was the point of this large move on USD JPY or UJ? So here we see on the 6th of November over here, okay, they were obviously identifying that the order flow was bearish, okay, and price was going down over here, and they were selling. They had actually showed me a screenshot of a trade that they had sold. I think it was around this order block, basically over here. They had sold there for price to continue going down. And while they did move their stop loss to break even, unfortunately, they were a victim of slippage on their brokers. So instead of the trade breaking even, as we see with this large move to the upside, they were a victim of slippage and it basically closed them out in a loss. Well, it was a minor fractional loss, but a loss, no doubt. And they asked me, well, where did this move come from? Why did this move happen? Was it a news event or was it some sort of announcement or what transpired here? Okay. And while there was possibly a news event, okay, I'm not maybe denying the fact that there was possibly an announcement that created volatility. Okay, let's not dispute the fact that news increases volatility in the market. What I will show you here is if we look at a higher time frame, we can actually clearly see why UJ over here bounced from this direction to the upside. This massive from here to here is about 230 pips. And they said to me, well, this must have been a news event. And I said to them, no, look at your chart. Look at the higher time frames. Don't be so focused on the 4 hour time frame. Okay, so if we start over here, okay, and we look at the higher time frame, well, let's just mark up a quick zone. And for the sake of it, if we look at this, this is the monthly time frame. Okay, so one would think, well, the monthly, that takes forever for price to get there. Okay, sure, it does, yes. But what about reactionary zones? Okay, here is a reactionary zone, a very high concentrated reactionary zone. We can clearly see on the monthly chart at this zone, price created this order block over here. Okay, and price blasted off from here. Okay, well, where did it trade up into? Well, if you did a basically something like this and you said, well, okay, price fell from here and rallied from there, it rallied into a premium and then price fell from that direction. Okay, but regardless of where it traded from, we are basically just looking at this monthly order block over here. Okay, so yes, monthly takes long to transpire. However, it is an important pivotal zone. Okay, I say pivotal zone in terms of a retail trader. They say, well, where's your pivot points? This is your pivot point in inverted commas. Okay, I don't talk like that, but for the sake of everyone's understanding, we can say that this is our pivot zone. So this monthly order block here, we know that if we've watched any of the order block videos, we'll understand that the wick, the body, and the 50% of order blocks are the sensitive areas of an order block. Okay, so here we have a monthly order block. And if we go down to that same zone and look at that monthly order block, which represents this horizontal red line over here, we can start to frame up in that monthly order block over here this bullish weekly order block over here. Okay, and for the sake of this, I'm just going to make it a green order block over here. Okay, so now we have a monthly order block and a weekly order block over here. Okay, so we can actually see that on top of that monthly, price then traded away and created another lower time frame order block, and you can actually see price trading into this weekly order block and bouncing off of this order block. Now notice I haven't included the wick over here. However, we would be right in saying from the wick to the wick is the order block. However, the most sensitive area is inside of the body. Yes, the wick is sensitive. Yes, the body is sensitive. Yes, the 50% is sensitive. However, the body itself contains the most majority of orders. Okay, so inside here is where most of the orders are sitting inside of that zone. Okay, the monthly order block we have marked up over here is a very sensitive zone because that is the body. So here we have the weekly, and on that same zone, on that daily, okay, if we go and look here, well, at this zone, we can actually see if on this daily here, there is a price gap over here. So this itself is telling us a story. Well, price is inefficient here. It's imbalanced. Okay. So when price is imbalanced, we like to have price balance. So you can see from the close of this candle to the open of this candle, there was about a 100 pip gap, or if you measure from the wicks to the wicks, it's about a 40 pip gap. It's still a gap nonetheless, and at some point that gap will be filled. And a lot of the time I get another question, well, how long does it take to fill a gap? Well, this gap was only recently filled, and this occurred in 2016 of November. So, 4 years ago almost, this gap occurred. So there's some sort of understanding as to how long gaps can take. You can actually see here that this wick down, sometimes on a weekly chart, body gaps like this, you see it's just a wick. They will like to fill with body. Why body? Well, because body contains more volume than a wick. So although they wick down and price was balanced, it is a volume imbalance. So the volume is imbalanced. Okay, so that volume got balanced and price then rallied. Okay, so if we mark up that order block over there, this last down candle inside of this weekly order block over here, I'm just going to make this one blue. Okay, and this would represent our daily order block over here. Okay, so if we zoom in here, sorry about that. This is that daily order block. Okay, so now we have a monthly order block, we have a weekly order block, we have a volume imbalance, and we have a daily order block over here. So if we look at recent price action as to where it had traded into, based on this 4-hour chart that person had showed me where they had sold into, and they were expecting price to go lower. Yes, they had sold from an order block, which is generally what we do, but you can see it had traded into this red line, this monthly order block over here, and the daily order block over here. Okay, so basically, when price trades into a higher time frame, obviously being much higher, which is weekly and monthly, this is going to be a very pivotal point because as you can see, price rallied here. And well, why is monthly so important? Well, think of it like this. How much money does it take to move price on a monthly chart? A huge amount of money. Forex is $1 trillion industry. Okay, so to be able to move price on a monthly and be able to close price at a certain level and protect certain areas or reject certain areas takes a lot of money. Okay, so all very well, there's wicks and price goes down and rallies and rejects, and then you can actually see that these wicks over here basically reject price. But in terms of closing price, this is what we are looking for, closing price on the monthly. Okay, so here we actually see when that person had sold, they were selling on a higher time frame, bullish order blocks, meaning they sold on a monthly bullish order block, they sold on a daily order block. Now, one shouldn't do that. So when you are following the order flow of the 4 hour, you should know the higher time frame to be able to tell you where these reactionary zones are. Without knowing these higher time frames, it will almost be impossible for a person to trade the order flow because of the fact that these types of events can occur just randomly, and one would say, oh well, it was news that made this rally. Yeah, sure, maybe it was news that made the volatility and increased the volatility. However, it was the orders sitting over here that made price go higher. It was the orders, not the fundamentals. And anyone that disagrees with me can come into a nice heated debate with me. I have no problem explaining in great detail as to why this would not be a fundamental, but rather a order. And you say, well, okay, this occurred in 2016, 4 years ago. That's irrelevant because price is fractal, and it does not mean that because it happened 4 years ago that there is no orders sitting over there. The orders can sit there for 10 years. The banks control the market, okay? So us as retail traders, it's highly unlikely that retail traders of any kind would hold on to a trade for 4 years, maybe 6 months, maybe a year, if that, if we're very patient for a position trade. But in terms of where big money is in institutions, they have no problem holding on to a time of 4 years for price. If they had bought there, they will protect those orders when price comes back to those levels. And that is why you see such a massive reaction, is because there is still orders sitting over here. Only an institution can move price this much of 200 pips from a zone and completely eradicate this move to the downside over here. No retail trader or majority of retail traders, all of their money cannot move this market in such a short space of time. This is huge institutional sponsorship over here. Well, we say, well, how would we trade this? Okay, well, knowing what is basically prices trading into, this daily, this monthly, this weekly, we can go down to a higher time frame, and we've marked it up. And once we've marked up the monthly, we've marked up the weekly, we've marked up the daily, when we get to that zone on a lower time frame, we can start to look for an entry. Okay, so here again, well, let me just mark up this order block over here that was created. And I'm just going to make this one pink, otherwise we're going to get confused. So there we have a pink order block, which is the 4 hour over here. So if we look at price, okay, once price makes this green candle and price closes this green candle, this is now an order block over here. Okay, so if we look at that in terms of a lower time frame as to where we want to take the trade from, so if I pull and I go down to the 15-minute over here, we can actually see over here. Okay, so when price creates that order block over here, it would have been created around over here when price trades through it, creating this order block over here. We can actually see, well, what time is this? This is 10 a.m. over here. Why is that important? Well, for me, on my chart over here, it may be different for you. 10 a.m. for me is the London Open. Okay, so price didn't randomly just start exploding from here. This was time and price intersecting with each other. Okay, so this order block here was created, this 4-hour order block. This daily order block had existed, this weekly order block had existed, this monthly order block had existed. Price traded, as we look here, let's just zoom out. We can actually see it basically coming down over here and getting into this higher time frame and stalling, and then there's some sort of consolidation when price trades sideways over here. It cannot go any lower because of the fact that there is higher time frames blocking price from going lower. Why do we call it an order block? It is blocking orders, an order block. Okay, the orders have been blocked from going lower. Okay, so here is a selling environment and here is a bullish environment where they are buying. Okay, so when price trades down on any time frame into a higher time frame objective and you get a reason to buy based on the higher time frame, you can then go down to your 4-hour, you can go down to your 1 hour, 30-minute, 15-minute, and start looking to scalp. Okay, you can start looking to buy on your lower time frame. Because why? Well, you have a higher time frame bias, so the chances of you scalping for a buy are much more higher percentage and more accurate if you are buying, scalping on a higher time frame, knowing the higher time frame. Without knowing this higher time frame, well, then you might be looking for sells. Okay. Now, we all want those great high risk reward trades. Well, sorry, not high risk, but good risk reward trades. You know, you risk one to make 1 to 5, or risk one to make 1.3. But without knowing this higher time frame, you won't get those kinds of trades. Okay, so even if you had bought up top here at this order block and you put your stop just below there, well, there's 30 pips. Okay, knowing the higher time frame, and you could have caught 200 pips. Okay, so if we say, well, okay, if we had caught 200 pips and our stop loss was 30 over here, that's a 1 to 6 risk reward ratio. That's better than most people I know. Okay, most of the time you're trading 1 to 1, 1 to 2, 1 to 3 at best. Getting a 1 to 6 is pretty good, you know. And the people who trade Wyckoff always gloat about, you know, I can get a 1 to 22 or a 1 to 40. That doesn't matter. What actually matters is making a profitable trade and doing that consistently. It doesn't matter if you're doing a 1 to 1, 1 to 2, 1 to 3, or 1 to 400. The fact of the matter is, if you can't do it consistently, and it doesn't matter how much 1 to 10,000 if you want to, it doesn't matter as long as you're doing something in the marketplace that is consistent, day in and day out, week in, week out, month in, month out. That is what is consistency in this place. And it doesn't mean that you have to have 10 cars, 10 houses, uh, all this cash printed and you're taking pictures and sending it on Instagram. That doesn't matter to anyone. Anyone that falls victim to that, well, then I feel sorry for you, because the fact of the matter is, this is real truth about trading, is that it is not as easy. But if you can identify higher time frames, then you can scalp, then you can day trade, then you can swing. You can do anything as long as you know the higher time frame. And this is why the higher time frame is important. Don't disregard the higher time frame just because you're a scalper or just because you're a day trader. If you know the higher time frame, you'll make great trades. Okay. So that was UJ, basically in a nutshell, as to why price rallied from that zone over there. Okay, so to move swiftly along, someone asked me to basically give them one of my trades I took that was a winner and one that was a loser. Okay, so this was NZD CHF. I don't normally trade this pair, but the same rule for me applied. I haven't been day trading much. I've only really been swing trading, just a bit of hectic at home with COVID and stuff, but it's not a problem. Still making some good money. Okay, so to mark up the same, well, here, this last down candle over here is a monthly order block. Okay, and that obviously when we see price last month, this is the October candle over here, and price traded down into that order block and rallied away. Okay, we can actually see that now if I go down to the lower time frame. What did it trade into? Not only the monthly, but what is this over here? And I'm going to make that one green over here, so we can say that that is a weekly order block. Okay, so this down candle gets traded through, so it is a weekly order block. Now we have a monthly order block, we have a weekly order block over here, and also now I've done my weekly, I've done my monthly. Okay, so when price traded down over there, okay, well, what was its objective? Well, if we look close over here, there was a little gap over there that was filled, so it had an objective to take price lower. Okay, and also trade into the monthly and inside of the weekly. If we look at this price as well, when it rallied away from this zone, well, this swing low to this swing high gives us a discount over here, like that. So this is a discount area, and that is the reason why price rallied away over here. The monthly, the weekly, and this fair value gap being closed, it is also discount, and price rallied. When it rallied, what did it do? Well, it left behind this over here, which is a daily order block. Okay, so that daily order block was created and pushed price higher over here. Then if we look closer at that zone, when price made that order block, okay, the next day price traded down into that order block and rallied higher. Okay, so confirming the orders sitting at that zone. Again, when price traded down over here, this down candle got traded through. So what does that become? Well, because this is a daily order block over here, so too is that over here. Okay, so here is a daily order block that got traded down into and rallied up. So we were expecting buys because it's a weekly, and price had already rallied away from that zone. So we were expecting higher prices. Why? Because the order flow on the higher time frames, the monthly, the weekly, the daily, were bullish, regardless of the 4 hour, regardless of the 4 hours order flow. Those order flows will be overruled by the daily, by the weekly, and the monthly. Okay, so well, where was price heading to? Well, if we look over here, I just want to grab this line over here. This is where I will point out my objectives of price, and we can clearly see here, sorry, that there was some very obvious reasons as to why price would likely go to those zones, and one of them were obviously this double top over here, which is equal highs, relative equal highs. It's a M pattern. So what does M pattern mean for retail traders? They sell. Okay, and over here you can actually see it's clear resistance as well. So resistance, equal highs, you know, retail traders like to trade resistance, support and resistance. So there's going to be orders sitting over here, and that's another reason why I was buying at the zone, because they were selling. Okay, so there was equal highs over here. There would have also been liquidity over here. Okay, but the overall objective was obviously to take this high over here. Okay, so you could basically say our profit scaled at these highs, at these highs, and at these highs. So that was my thinking behind the NZD CHF trade that I took, was because of the monthly order block, the weekly order block, the daily gap that was filled over here. And when that gap was filled, it came into a discount of this range over here. and the daily order block was created when price rallied away from that zone. Then price rallied up, had a pullback, created another order block getting traded through. This order block got then tested over here after raiding the liquidity of this high. You can actually see it falls down, and basically there was no momentum to the downside after raiding these equal highs over here, which one would expect if they were going to run liquidity because the order flow was bullish. So we were then targeting this over here. And one can say, well, it's clear why retail traders also sold. If you do this, that's basically like a trend line style type of trading where they basically sell at the trend line. And that is why trend lines are garbage, because price does not move according to a trend line. Okay, so price trades where liquidity is based. Okay, so that was one winning trade I made, and I'll show you one more trade here on AUD JPY, which I lost. And basically I wanted to sell over here on this order block over there. Okay, and I had basically identified that there was obviously a gap sitting over here, and I had drawn some sort of I think it was my fibs from, no, it was, sorry, it was this swing high over here, and that came into 79% from these lows over here. Okay, so basically I was looking to sell at a premium over here, and inside of this order block, so I had basically set a limit at this order block. I think it was about 50% of that order block, and I had put my stop, I think it was just around this highs, thinking that if they wanted to raid this high, they would just take it above here, and I was just stopped out about when it rallied up over here. I did get back into the trade, and I think I closed it when it ran about 60 pips to this downside over here, which covered the stop loss. So I think I had about a 30 pip stop loss sitting over here. Okay, and then that covered. So basically I broke even plus a little bit more extra on this AUD JPY trade. Okay, okay, so I'm going to speed things along. We're running out of time here. And basically, yeah, someone wanted me to go over gold. So if we look at gold, well, gold's Y price recently fell from this zone over here where we saw that massive 1,000 pip move in one day. Well, basically, we could say that this green candle over here is an order block, okay? And this is a higher time frame weekly order block. So we know that the wick, the body, and the 50% levels of this large order block are sensitive areas, okay? So I'm going to reduce the range of that. So from the wick to the body, so 50%, about there, and that is the zone we can look at for selling opportunities, because we actually see price coming in there and it rejects there and then it goes down. Okay, so that is obviously the weekly, and if we go down to the daily over here, well, the same thing applies, basically, that the last up candle over here before this move to the downside is the order block. So this too over here would have been an order block. Okay, so this last up close candle before the move to the downside gets traded through. This candle gets traded through, making the order block. Okay, at the same time, this weekly order block is in play because obviously it is a higher time frame order block, so we would expect price to go to those levels and reject down. So at the 4-hour level of that zone, well, when price came into that zone, there's obviously liquidity above that high over there. Okay, so when they raided that, you can actually see it's touching inside. Let me just make this red. So that high over here had liquidity sitting up top there. And when that high gets raided, well, then price rallied into it, trading into the weekly order block, as this green line represents, trading into the 50% of this daily order block, as it suggests, raiding that highs and price then dropping. So sure, maybe it was news or some sort of COVID news or vaccine news or whatever the case is, but price effectively fell from where higher time frame order blocks are. This is why I've been saying to everyone on the group, on the Telegram, that they must follow higher time frames and be aware of what is happening on the higher time frames, especially now through this period, because this is where price is going to react. Okay, price, the year is also coming to an end slowly, and institutions will be looking to cash out for their investors, hedge funds cashing out. Okay, so there's going to be a lot of hectic market movements and big sentiment and quarterly shift changes occurring, not only because it's the US election, but also because it's approaching the final end of the year's end, which is December. Okay, so that was gold. Okay, so if anyone has any questions right now, they are welcome to ask. Your mics are muted, so you just have to unmute it if you want to ask a question.
Good day, Darren.
Hi, Kay, go ahead.
All right, question. Yesterday, I see you put in the group about the copy trade. I don't think I quite understand it. My,
Kay, you'll have to ask me that on Telegram because this, we are just looking at the charts here.
oh, all right, no problem.
So if you have a question about charts and, any pairs or concepts or something you're not sure of in terms of what we teach on YouTube, then you're
Yes.
more than welcome to go ahead. Otherwise, you can ask those questions on Telegram.
All right, no problem. Thank you.
Does anyone else have any questions? There were so many questions in Telegram. Um, David, you had a question. Okay, I do have a question here. How do we know which liquidity points will be targeted? Okay, well, that's pretty simple. So over here, going to the trade that I took on NZD CHF, okay, it is going towards the higher time frame order flows, okay, and when price had come down here, underneath all of these swing lows over here, let me just represent that with a small little X there. So underneath these little swing lows and price rallies away, there is liquidity sitting below these lows, below these lows, below these lows. Well, why did liquidity that was sitting below this swing low over here not get taken? Okay, well, the simple fact of that is at some point, the institutions need to sponsor themselves, meaning that they need to protect their own orders and their own price levels that they have bought at. Okay, so if they had bought over here, where the original monthly order block was created and price rallied away, anytime it gets near their orders that they have placed, they will take price higher. Why? Because they are buying more. They do want to protect their orders, so it is called institutional sponsorship. So you can expect liquidity to be raided where there is no institutional sponsorship or lack of institutional sponsorship. So this represents obviously institutional sponsoring themselves by not allowing price to go near any sort of low over here. However, all of these lows were taken no problem. Okay, so they are sponsoring themselves because they are going long. They are net long on their positions and they have no problem raiding liquidity to the upside, even though this is higher time frame order blocks, dailies, weeklies. The monthly is telling us that this is where they are essentially buying from, and they will look to sponsor themselves at this higher time frame. You guys need to go and practice this. Go and back test the fact that what I've shown you here can give you fantastic entries. Okay, I'll actually show you one more example of a very good entry. So this is EuroCAD. Okay, and if we mark up this order block over here, this green order block, this green close candle got traded through to the downside over here. Okay, now if what I showed you based on a higher time frame, when price trades into a higher time frame order block, well, you can expect price to react at that zones. Okay, so it's quite simple really. All you need to go and do then is mark up a higher time frame, go down to your lower time frame, and when price reacts off of that order block, this blue line representing that order block, well, you can look for an entry. If you had watched any of my previous videos, well, here's an entry technique where I say, where is the nearest IPL over here? 200 over here. So here is the 200 IPL, okay? And regarding the entry technique, if you're looking for a sell setup, you will anchor your fibs looking for a sell from the IPL to the low of the candle where the rally started again. So here's the anchor point of the IPL to the body that started the rally, and price trades into a premium because we are looking to sell. Why are we looking to sell? Well, it's quite simple. We have the daily order block over here. Quite simple, really. Go down to a low time frame. Well, there's your scalp. And into here, put your stop just above here. Well, there's 20 pips. Can possibly even put it on the actual order block itself. Well, there's 15 pips. I don't know how big your stop losses are for when you scalp, but generally speaking, you want to be taking less than 20 pips scalp with a stop loss of 20 pips. If you're not trading with a stop loss on a scalp, you're doing it wrong. And anyone that tells you otherwise doesn't know what they're talking about, because you have to have a stop loss, a point of exit when you have a trade. Anyone that trades without a stop loss is a cowboy. There's no room for cowboys in Forex. Okay, so hopefully you guys have all learned something in this session. And thank you for watching and joining. And I will see you all in the next one.